Good evening, everybody, and welcome to Wednesday's Real Talk on Real Estate. So, I want to talk to you guys today about how to prepare for the multifamily crash. That's right, I just said it, multifamily crash. Now, some people are sitting back going, Jerome, in multifamily, the industry is going to crash. Yes, we're going to see some. We're going to see some blood in the water. There's going to be some catastrophic investors that will land up losing their portfolio. And here's what's crazy, is that there's an unstated variable in the multifamily space that when you have to give back your keys to the bank, meaning that you go to the bank, you can hand over your keys to your property, you are pretty much banned indefinitely in the multifamily space. As a GP and LP, you just kind of ban yourself out of the industry. And there's big investment groups, people that over the last 2 years went from small little syndication groups where they had maybe 800 doors to now they have like 20,000 doors. There's groups in the last 3 years that have scaled to that. And so when they scaled to this, they were thinking that things were going to continue to just rise and they were going to continue crushing it forever and that the market was going to continue going up. I saw this in 2008. It was absolutely absurd. I sat back and I was one of them, so when I sit here now and I see people in denial, I was like, damn, that was me just a few years ago. So here's what I did. I want you guys to take some notes on a few things that you can do right now to prepare for the multifamily crash. Now, if you're somebody who's already invested in multifamily and you're going through the crash on the negative standpoint, I apologize. I can't do nothing for you. There's nothing that I can do to save you. All I can tell you is please DM me your phone number and I can potentially just assume your loan, assume your property, or go in and purchase it at fair market value based on current cap rates, interest rates, valuations, and what it's actually performing at today. And that's what I really want to talk to people about, is how you strategically position yourself to be able to get ready for the multifamily crash. Now, we build multifamily, but all of our multifamily is in the affordable housing sector because we knew this was coming. I've been talking about this since 2018. My whole business model was strategic in the fact that I said, when the market crashes, where are people going to go? They're living in Class A multifamily where they have all the amenities and they just need to sit back and save money because of what things are with inflation and economics, so forth and so on. And what they're going to do is they're going to go into properties like ours. They're going to go into a product that's built that looks, feels, and tastes like Class A real estate that they're already living in without the amenities. We just build it simple, and we're able to de-amenitize it. They can go get a gym membership at Planet Fitness or LA Fitness or wherever it is, take that money there, save thousands of dollars, hundreds of dollars a month to be able to utilize the offsite facilities that are already available to them already that are not being utilized by tenants in most of these facilities nonetheless. So we're able to go and build them for less, manage them for less, run them for less, and our net operating income still pencils out real similar. And we have a very strategic business plan that is solid. So don't look at our properties, but let's go look at these Class A properties or some of these Class A vintage properties that are older that people have overpaid for. That have went in, they leveraged money, they did value add to them, meaning they did renovations. They were in hope that they could cash out, refi, or sell to another investor. So they have investment capital, the syndicators, and they also have debt from institutional money, and they have compression in the market. Okay. Cap rates are going up in alignment with interest rates, and they should. Commercial family brokers are still in denial themselves, and they're underwriting these things at like 5% cap rates, which is total bullshit. Don't be doing that. You need to be able to underwrite these things where you're not servicing debt on top of the cap rate. So that way, if there's a 5% cap rate and you're buying this at a 6.5%, 7% interest rate, who do you think's funding the other 2% of that debt on top of that interest rate, on top of that cap rate, if you're not buying it at the interest rate and cap rate are not in alignment? You are. And so don't buy that. That's the stuff you want to go buy off of people or assume if they have lower interest rates. Now, I had a video that I did about a year or two ago, and I said, don't be a Dave. And what I mean by that, there was a guy, his name was Dave. And I'm going to explain this to you because it's going to be complete validation to what's going to happen, how you should strategically position yourself right now. He had a portfolio of 4 commercial properties, 3 of which were unbelievable properties, fully leased, cash flow like beasts. And he had this one piece of crap property that was a 3-story office building that he just cannot lease. He overpaid for it. And he had all 4 properties under one entity, and it was his own personal DBA, doing business as, which means it wasn't under an LLC, corporation, or anything. Now, if some of these investment groups have these properties all in a conglomerate investment, what's going to happen is if they have just 2, 3, or 4 properties, but yet they have 10, and those 2 or 3 properties are drawing down, but they have them all under the same portfolio. Guess what happens to the whole portfolio if these 3 properties go south on them? It's catastrophic. It blows up. All 10 properties land up getting taken back, and they have to hand in the keys to all 10 properties to the bank, in spite of the fact that only 3 of them are bringing down those 10 properties because they're all under the same entity. So it's a failing entity with 10 properties where 7 of those properties are still cash flowing, just amazingly good. Okay. So here's what you need to be doing. 1, if you have garbage assets, okay, meaning single family homes, little retail or office or Airbnbs or stuff that's just not producing the cash flow and revenue that you think it should be, or if you have properties that are sitting and you have money and capital tied up and you're sitting back to make a big profit, sell it even for a small loss. Don't take a catastrophic loss on it, right? Don't ruin yourself over it, but sell off properties and become liquid. Because right now, what's going to happen is what I'm talking about not being a Dave and being able to go in, and these people that over leverage themselves are going to have these properties, they're going to start losing. Okay. Right now they're in denial mode. And what's happening is they're going from denial to survival mode. And so they're sitting back, they're servicing this debt. And what's going to happen with these Class A amenitized properties is they're going to start going down. Now, some of you guys are asking, well, why, Jerome? Why are these properties going down? Well, rent rates went too high. Things traded at too expensive of a price, at too compressed of cap rates. And so now servicing that debt has become extremely, extremely complicated. For the first time in over a decade, there is more inventory going up and coming to the market than there are tenants looking for homes. Now, we are still 4.7 million rooftops in multifamily short of being where we need to be. So there's still a massive need. This isn't going to be a long-term compression. So that's why I'm advising you guys to be able to become liquid in the assets that you do have that are not cost producing. You guys all know what they are. I have little retail centers that I have been hashing off because they're a pain in the ass, bad tenants, high maintenance, that kind of garbage. Just liquidate that stuff. Just get rid of all that bullshit. Put that money aside in a bank account and get ready to buy. Okay. Now, what you need to learn and what you need to study is you need to study how to become an asset manager if you aren't already. Now, for those of you guys that have no desire of becoming an asset manager, you need to learn the difference between what a general partner is in syndication and what a limited partner is. Now, some of you guys are sitting back going, Jerome, I don't know how to raise capital. I don't know how to do any of this stuff. I'm afraid that I'm not going to be able to learn this stuff in time to be able to go in and invest in these assets. Yeah, you're wrong, because there's general partners and there's GPs and there's good syndicators out there, but you have to interview them. See what they have in their portfolio right now. See what their portfolio financials actually look like right now. See if that portfolio is abundant in cash flow and still stabilized really well, because a lot of syndicators are over leveraged. And so if their assets are in distress, you know that they haven't been buying correctly. And there's going to be a lot of them, guys. There's going to be some people that you've been admiring for a very long time, sitting back in financial distress because of the properties that they purchased, overpaid, and haven't been able to refinance. You watch, as God is my witness, you're going to see people go down that you're not expecting to go down. So this, ladies and gentlemen, is where opportunity arises for you as a general partner or a limited partner. Just understand those two. So after this, there's other videos that I have beyond this that talk about some of the strategic learning of what I'm talking about here. And so I'm going to give you a list of them right now. Okay. So these are the things as a limited partner and a general partner that you need to learn. Okay. You need to learn what gross income potential is, GIP. That's the money that the property potentially can make. That ain't the money that it's making. It can potentially make, okay? Because this is all underwriting parameters. If you get good at this stuff, ladies and gentlemen, you are going to strategically position yourself to be able to win. Now, what I did when I was learning this business is I sat and watched video about GIP, gross income potential, and GOI, gross operating income. That's the income that's actually grossed in a property, and it's the actual income that property actually generates from all the rents, the late payments, the credit checks, from having dog deposits, security deposits that go bad, all of the income that property produces is the gross income potential. Then you need to know and understand what net operating incomes are, what an NOI is. That's when you take all your expenses, property taxes, maintenance, repairs, everything, all the expenses, electricity, pools, maintenance, everything that expenses on that property, and you add all of those expenses up, property insurance, everything, and you subtract that number, all your expenses from the gross operating income, that's your net operating income. That's what the property can actually and viably produce to be able to pay back debt and a return on your investment along with your investors. LPs, GPs, listen up. You need to understand this stuff. If you don't understand what these are, you need to start studying. You can go in and watch it on our content. If you want to watch our content, you want to be notified when that content's coming out on some of the new stuff and even the older stuff, both great, then pound that thumbs up button, click and subscribe to our YouTube channel. You'll get notified every time we put that stuff out. Okay. Now, those aren't the only things. Now, you need to understand how to assess cap rates. You need to understand how you take a net operating income and the value of the property, okay, what they're trying to sell it for, and how you assess a cap rate. A cap rate is the amount of money that property nets if you paid cash for it, okay? That's the amount of money the property makes if you paid cash for that asset. Now, since most of you guys are not going to be paying cash for it, there's debt on it. This is where people have got themselves in trouble right now. They've went in and assessed too much debt at too low of a cap rate. And so they can't afford to service their debt. So because their net operating income doesn't allow them to service that based on the cap rates that are real today, because interest rates are high, now people are moving into a financially distressed state because there's more available on the market than what there is bandwidth to be able to lease in the immediate market. Now, it'll take an absorption rate of about 2 years to get this stuff filled. And what happened was there was such a massive need for multifamily that everybody started building it, and they started building this Class A products. And all of a sudden, you guys drive around all the cities. You guys go to the big metro areas around the Denver Beltway, the Dallas Beltway, the Metroplex, Austin. You guys go into Salt Lake City, Utah. You go into Phoenix, Arizona. You guys go into Boise, Idaho. You guys go into Tennessee. You guys go into all over Florida, around Orlando, Miami, all the Panhandle. You guys go into California. You just drive off through the freeway, you take the I-10 or whatever it is, you guys see multifamily being built everywhere. Stick frame construction going up all over the place. Now, what's going to happen is there's more permits pulled in 2021 and 2022 than there ever has been in history. So what's going to happen is all this inventory is going to come to the market within a given amount of time over the next year, and it's going to take time to stabilize these assets. And so some of these people aren't going to be able to stabilize them quick enough. Opportunity, okay? That's where opportunity lays. Now, when this happens, we're going to see a compression. There's going to be so much going out to the market that rents are going to drop. There's going to be contingencies that are put in where people are able to go in and get a free month's rent. They're able to go in and negotiate lower rent rates. And so gross operating incomes and net operating incomes are going to land up going down, meaning that valuations are going to go down. So the 1, 2, 3, 4, 5, the sixth thing you guys need to learn is you guys need to learn how to value properties, okay? Some people are scratching their head going, oh shit, Jerome, this is a lot. Yeah, it's a lot. But how many of you guys want to make money in multifamily? It's going to take you a little time. Get to work. Start watching some videos. Stop watching the garbage that you're watching on television, YouTube, and everything else that's not worthy of you watching, and put your time and invest your time and mental state into something that's going to convert wisdom, knowledge, long-term information that you can utilize. It's tangible. You can generate revenue and profits from it, right? Yes. And so you need to learn how to value properties, how you take a cap rate and a net operating income, and based off of the cap rate, the percentage that the property makes net, if you paid cash for it, and the amount of net proceeds that come into that property, and how you divide them and get a value on that property so that you can assess a property just based on what's going on in the marketplace. Because then if you can assess values and you can assess cap rates, you can understand how to buy them. Okay. These are the things most people don't know. This is the things that a lot of general partners claim they know, and they know it a little bit, but they don't know it well enough where they can dissect this stuff forward, backward, inside, and out. So look, ladies and gentlemen, I'm not going to go through all of these on this video, but I want you guys to become aware, because this video is about what you need to do to prepare for it, not actually do it, but prepare for it. So I'm going to give you the information, and then you're going to go back, and at the end of this video, I'm going to put up some other videos that you guys can actually click on the link and watch other videos on how you assess net operating income, cap rates, gross operating income, and valuations of these properties, so you can go out and strategically purchase properties over the course of the long term. Okay, now, so we're going to liquidate properties. We're going to go in and we're going to start underwriting deals. Okay. Syndicators, you need to start raising money. Now, for some of you syndicators, you guys are only raising money on equity. There are some people that are willing to give on equity, their money on equity and on debt. So you syndicators, you need to start creating an email list of both debt investors and equity investors. Because when the stock market is down and interest rates are so high, that a lot of investors, they just want a return on their investment. And so one of the big things that you can do is, if you offer both debt and equity investment opportunities to raise capital for limited partners and for your projects, you're going to have a bigger bandwidth to be able to go out and start raising capital to start taking some of these assets down. Now, you don't have to go out and start doing 100 unit, 200 unit, 300 unit deals that are in the 30 million, 50 million, 60 million, $70 million asset class like we're doing. You can go off and do what we did for years. You can go off and buy smaller stuff, little $5 million, $8 million, even $2 million assets. That stuff is also going to become available, ladies and gentlemen. It's not just the big stuff. It's the big stuff, the small stuff, and everything in between. Okay. The same thing that people do with big assets, they're doing on medium assets. The same dumb mistake that people are doing on big purchases, they're doing on little purchases. The opportunity doesn't just lie on these massive deals. So if you're just getting your feet wet and you want to get into this stuff, start understanding the underwriting process of this. Now, okay, I'm going to go, that is the pre-existing assets and what you actually need to do to strategically get into that stuff. Now, for new construction, for those of you guys that want to build this stuff new and you want to understand exactly what you need to do to prepare, here's what you need to do. You need to know everything that I was talking about under the existing assets so that you understand how to underwrite these, but you also need to know the difference between the two types of pro formas, okay? Now, on pre-existing assets, pro formas tell you what the market is doing on existing assets, what it's supposed to do in the future, okay? Pro formas are worthless on pre-existing assets. Crumple them up, flush them down your toilet. If you clog your drain, call a plumber. Look, ladies and gentlemen, throw pro formas away. Whole point being. Now, for those of you guys that are building new stuff, everything is based on pro formas. So pro formas are gold. And what you need pro formas for is you need to be at those pro formas on properties that are existing right now and see exactly what is being paid for rent on those properties right now, what those properties are actually performing at in real time. Okay. And the reason you want to know that is that way you know how to underwrite your project based on current numbers, what the market is actually bearing, rents, occupancy, and in the asset class and demographics that you're actually looking to build in. And so you need to get good at finding out how to read pro formas and what those pro formas mean in the new construction sector so that you can go out and build this stuff. Okay. Now remember, pre-existing vintage stuff, pro formas, 100% worthless. New construction, being able to set yourself up for success, pro formas are everything. Okay. So understand that. Now, prices for dirt, ladies and gentlemen. There's a bunch of stupid land entitlement people out there that really don't know how to entitle land, most of which. So if you're listening to me, I'm trying to buy your land and I've been negotiating with you, I'm calling you stupid. Yes, I am, because you're stupidly selling land and people have been paying those prices because there was a bandwidth of time that people were trying to get these products up. Well, you have to create value in your land, ladies and gentlemen. If you don't create value in your land, you can only have the equity standpoint of what you paid on a retail basis. So what I'm telling you guys is land is worth less right now and everything starts in the dirt. So if you're going to go out and build this stuff, ladies and gentlemen, where you start with your discounts is the purchase of the land right now. So at one point in time where maybe theoretically the land for multifamily in a decent area that's good strategic for multifamily builds in our market sector that is bearing profits and is entitled, we're willing to pay about $15,000 per door up to about maybe $20,000 per door. Now, ladies and gentlemen, if we're going to back it up to 2019 numbers. My number for multifamily land, non-entitled, was $10,000 a door. and I would not budge over $10,000 to $12,000 per door. 12 to 13 would be my high point, So right now I would stay between $10,000 and $15,000 per door on non-entitled land. Meaning that if you're gonna be able to build 50 doors, it's 50 times $10,000 per door or $12,000 per door. But don't go over $15,000 per door on in areas that are just good. Now, if you have an excellent area, like I'm talking just absolutely unbelievably because of traffic count, you have the upper echelon of economics in the area that you're building. It's just a desirable area to live, build, and invest. Then you could pay a little bit more. But even that, some of that stuff was selling for between $40,000 and $70,000 per door. Now, guys, $20,000 to $30,000 per door. Be careful. And yes, it's massive discounts, but understand that if you don't get those massive discounts now, you're only positioning yourself to go out and lose or go in and land up in the same situation that some of these other folks are already in. Guess who's going to land up buying your stuff? Me and my students. Me first. I'm going to go in there and go, damn, this person jacked this shit up. They didn't pay attention to me. Now I'm going to go in and buy it from them because now I'm going to take it down at a discount. I'm going to liquidate all of their liquidity so that way I push down all of their equity in that deal, and I'm going to get it for what they have in debt on that thing. And I'm going to pick it up for debt prices, and they're going to lose everything, all of their equity in that thing. And so I'm sorry, just underwrite things correctly. That's why that's so important. Now, look, ladies and gentlemen, this is the time to win. This is the time to win. This is what we've all been waiting for. And so I always tell people when the market is hot, people sit back and go, I'm just going to wait right now because things are so hot. I don't want to pay high prices. I'm going to wait for a discount. And then the market goes south and and everything's discounted and they're sitting back going, oh my God, I'm scared. The market tanked. Should I be buying right now? So you have to decide, like, do you want to buy or do you want to wait for a high market or a low market? It really doesn't matter what market you wait for. Every market's a good market to buy. It's just the strategy on how you buy. Now, I always tell people every market, my whole life for the last 25 years, we've always purchased no matter what the market was. In fact, the way I got out of the 2008 recession was I bought more real estate. I just bought different type of real estate, entirely different asset class of real estate that was cash producing at that time. And to service the debt on the garbage I had that wasn't producing cash. So it's not whether you should be buying or not buying. It's what you should be buying, how you should be buying it that really makes the biggest difference in the world. So ladies and gentlemen, if you are just joining us now and you didn't watch us from the beginning, it's okay. I'm going to post this live video. You need to go back and rewind and watch and understand exactly, ladies and gentlemen, how you need to prepare for this market crash in multifamily to strategically position yourself to win on purchases and new builds. And then I need you guys just to post in the chat, #repeat. Okay. And don't forget, if you like the content, you want more content, you want to be notified of how you guys can learn how to get GIPs, GOIs, NOIs, cap rates, and values and understand that stuff and get notified when we do it, smash that thumbs up button, click and subscribe to our YouTube channel. That way you get all this incredible information that we're giving you guys for free. Ladies and gentlemen, go out there, crush it. Let's buy some multifamily in this compressed market. You've been waiting for this. Multifamily's been sexy for a long time, and some of you guys have been on the sidelines just waiting. Some of you guys that have been syndicating and on the sidelines doing things correctly, being conservative. Now, ladies and gentlemen, is your time to win. Let's go out there. Let's crush it. Go out and compound your success. God bless, and go out and have a great day.